my friend round. I thought, hello, new shoes, bye-bye blues. Hey, I put some new shoes on and suddenly everything's right. I said, hey, I put some new shoes on and everybody's smiling. It's so inviting. No, short on money, but long on time. Slowly strolling in the sweet sunshine, and I'm running late and I don't need an excuse. So wearing my brand new shoes. Take me wandering through these streets where bright lights and angels meet. Stone to stone, you take me.
Please take your seats. The program is about to begin. Please take your seats. The program is about to begin.
Stone to stone, you take me on. I'm walking till the break of dawn. Hey, I put some new shoes on and suddenly everything is right. I said, hey, I put some new shoes on and everybody's smiling. It's so inviting. No, short on money, but long on time. Slowly strolling in the sweet sunshine, and I'm running late and I don't need an excuse. So wearing my brand new shoes. Oh, hey, I put some new shoes on and suddenly everything is right. I said, hey, I put some new shoes on and everybody's smiling. It's so inviting. Oh, short on money, but long on time. Slowly strolling in the sweet sunshine, and I'm running late and I don't need an excuse. So I'm wearing my brand new shoes. Why do you build me up, buttercup, baby, just to let me down? Unless me around, and then worst of all, never thought, baby, when you say you will. But I love you still, I need you more than anyone, darling. You know that I have from the start. So build me up, buttercup, don't break my heart.
Please welcome to the stage Bloomberg's Alexandra Semenova.
Good afternoon, everyone, and welcome to Bloomberg Invest Tools of the Trade, ETFs, and Options. We are so thrilled to have you all here with us today, both in New York and virtually from other parts of the world, for what are sure to be important conversations surrounding various instruments within financial markets. A few quick announcements before we begin. We want to acknowledge our U.S. presenting sponsor, Invesco QQQ. For those of you in the room today, please feel free to enjoy your lunch, take notes, and you have Wi-Fi information available on your badge as well. We'll try our best to leave some time for questions at the end of each panel. For those tuning in virtually, if you have any issues with your audio or video quality, you could refresh your browser, or you could defer to the chat box in the right-hand corner for support. And of course, don't forget to engage with us on social media using the hashtag Bloomberg Invest. You can also follow Bloomberg Invest on Twitter, Instagram, LinkedIn, and if you have a Bloomberg terminal, you can run the function Live Go. I'm so excited to kick things off and present to you Paul Schroeder, Invesco QQQ Equity Product Strategist.
Thank you, Alex. As Alex said, I'm Paul Schroeder, QQQ Equity Product Strategist with Invesco, and definitely excited to join you all here at Bloomberg Invest this year. So today's lunch session, we'll be discussing two different topics, ETFs and options, two of my probably biggest passions I have within the financial industry. So ETFs overall obviously have played a very pivotal role with giving access to investments to the everyday investor. QQQ has played a very pivotal role within that industry, with it being around for over 25 or almost 25 years here coming up in March, and being one of the largest ETFs out there, the fifth largest ETF in the world. We have around 190 billion in AUM right now, and it makes it the largest large cap growth ETF in the world. accounting for about 27% of all assets within that specific category. So very excited to hear what the panel has to discuss with the changes and the trends that they're seeing in the ETF market. Specific to the second topic, which will be options, we've obviously seen a huge explosion within the option industry, in particular over the last year, really coinciding with the listing of options that now expire on a daily basis. We've seen QQQ's option ecosystem really grow during that time. It has the second most traded options out of all ETFs out there, only second to SPY. So very excited to hear how the option market is shaping the upcoming market and how things are trading with that. So with that, I'll pass it along. I believe Matt will be moderating the first panel. Thank you very much again, and enjoy your lunch.
We should talk about it later. I love London.
Now, let's get started on a panel on the explosive growth of the global ETF market. I'm so excited to present our first panel in conversation with Matt Miller, Bloomberg ETF IQ co-host.
All right. Well, welcome to the ETF panel. I'm very excited. I'm Matt Miller. I anchor a television show, a weekly show on Bloomberg called ETF IQ, and I try and be an unbiased journalist, but I love this product and this package, this industry. Ever since I was kind of introduced to it when I was living in Europe, I just automatically saw the value in it and thought it was so cool. So I'm happy to be up here and excited to talk to Stephanie Guild, who's sitting at the far end there, from Robinhood, Amanda Rebello from Xtrackers DWS, and JJ Kinahan from Tasty Trade, also IG Group, and it's essentially TD Ameritrade, right?
No.
Unrelated. Sorry, Tasty
Was
Trade.
TD Ameritrade for about 16 years.
Yes, okay, there you go. So, but we all are excited about what's happening and sometimes also surprised. This year, I think the main theme of ETFs has been about active. JEPI, the JP Morgan one, has taken in, I think, $9 billion. And now we had a great story on the terminal yesterday. Goldman Sachs is trying to essentially imitate that. But there's so many ways you could go with active, and you could talk about AI in active, or you could talk about model portfolios. And so I just want to start it off with your take. And Stephanie, let's start with you because I think it's very interesting that investors, like the whole phenomenon of Robinhood is fascinating to begin with. But I assume that they essentially would have started with plain vanilla ETFs like everybody else and then moved into active more. How do you see the trend?
We have less in, it's a growing segment of what our customers are investing in, but we have less in ETFs than the average. And so then versus the marketplace, I think it's ETFs are like 17% of assets, and we're about 12% of our assets at the end of April are in ETFs, but it is growing. So I think our investors, given that we really grew our customer base during COVID, that it really was like a single stock and options, and things happened last year in the marketplace that people, I think, started saying, like, maybe I actually don't know necessarily what I need to spend more time learning how to invest. And then you've seen the growth of not only customers investing in broad-based ETFs since that time, but you've also seen them use it as, I'd say, places to kind of manage a portfolio. And that could even mean like short ETFs and the inverse and the extra long ETFs.
So, JJ, tell us about your journey from TD Ameritrade to Tasty Trade in the IG Group, and what your customer base is like.
Sure. So at Tasty Trade, we're the same people who started Thinkorswim, and so we kind of got the band back together, if you will. And so with that, we have a very active client base, and I think one of the really interesting things about ETFs, as Stephanie said, A lot of people have turned to them in the last year and a half because of uncertainty about the market. We saw from June until November of last year this incredible growth rate. It's kind of flattened out since then, but then there's one other thing that I think is underrated in the interest in ETFs, particularly those like SPDR, IWM, QQQ, and that is the whole thing of one-day expirations and options. That's brought a whole new interest into these products because there are a lot of people who are trading those who may not have been trading ETFs, more of them trading a lot of single stock names in the past that are like, you know what, these are interesting products for me not to have to take that risk on earnings and on bad announcements, et cetera. So trading, and I think it's lack of conviction in what's going on in the market right now, be it for what we just got over with debt ceiling or with the Fed, et cetera. And so with that, people have turned to the ETFs, and this is just another element I think that's added a lot of interest to the ETF market.
But do you have more of a retail base?
Oh, we're all retail.
Yeah. So, and Amanda, I figure your Xtrackers are probably used more by institutional, but what's the breakdown? Do you know?
Yeah, so from our business perspective, we're always engaging with financial institutions or registered representatives. From a FINRA perspective, we don't deal with end retail investors, but clearly we see the trends of the retail space through the intermediaries that we're working through, so platforms that have self-directed investors as well as wealth managers as well. In reality, we see that probably about 60% of ETF utilization is still with retail, but we've seen some developments in the ETF industry over the past decade. So things like the ADV of ETFs overall, the CAGR is about 12.5% per annum over the last decade. This means that now we see more institutional utilization because ETFs are now a genuine Delta One instrument versus swaps, futures, other exposures or other wrappers that institutions have been using for index products.
It's really interesting because I would have thought, I've always thought since the beginning when I first learned about ETFs that it's a great retail product. And now I see institutions using it a lot just for like a liquidity base around the portfolio, right? But Stephanie, I can't believe that. I would have thought the kids on Robinhood are buying ETFs. It seems like a great product for the kids, but they're just learning it.
They're just learning it. I mean, there's so many of our customer base who are brand new to investing. And that's how we've tried to introduce them to investing because we think it's sort of get a lot more diversification, as JJ said. And we have actually built some recommended portfolios using ETFs. And I think that's another reason why the kids are starting to learn it because we're putting it in front of them. But they're not just, like, the trends that I've seen is that they're not just using the broad-based ones. They are using, like I said, the short and inverse, but also thematically. Like, last year we had a uptick in the usage of oil, the actual commodity ETFs, and that has fallen, right, because, well, we've seen what happened, oil prices have fallen. And then you've seen an uptick in more yield-oriented ones, for example, and, of course, more tech-oriented ones.
Right, and of course, yield is a huge draw right now. On the other hand, we've seen some bond ETFs see outflows, right? As people get back into money market funds, they're just looking for a higher return. What do you see, JJ, in terms of the trade around we finally get yield, we finally have safe returns?
I think it's really interesting in that if you look at the what's going on with the bond market overall, this is the first time for many investors, and Steph said particularly younger investors, that they've actually seen the assets that they buy really kind of go down. And so I think that it was a little bit of a shock to them that when they bought a bond, even though their yield went up, the bond itself went down and people weren't used to that. So it hasn't, I think retail hasn't been as fast to run into that as you might expect in a rising rate environment, and I think that's why you're seeing continued interest in things like SPDRs and QQQs, et cetera, because people like the concept of the principal going up. One thing Steph brought up, though, if you don't mind, that I really, we talk to our clients all the time about, educate them on how these work, and I think when it comes to the sector ETFs, one of the things that people have to be careful of is, I just pulled the XRT this morning, and this is not a rip on any ETF, so please don't take it at that, but I think it's important that people understand what they invest in. And so if you look at the top 5 names in there, it's Carvana, GameStop, Upbound, which has Rent-A-Center, Amazon, and Camping World. This is not to say there's anything wrong with that ETF, but I would almost guarantee that if I asked everybody in here to name the top 5 stocks in the XRT, Amazon would have been on everybody's list, but outside that, I'm not sure the rest of them would have been. And so my whole point is this is the kind of thing I think we owe our clients is to constantly say, hey, if you're going to do these, do you know what you're actually buying?
Carvana is a hot story today, and it's funny because on my pre-show meeting this morning, every time there's a Carvana story, somebody on the call is like, wait, didn't they go bankrupt? I feel like they definitely did at some point, but they haven't yet. They haven't, in case this is live.
Oh, that's news. To me, I thought they were too.
But I think JJ raises a good point. I think one of the benefits of ETFs has always been the transparency that can be offered. So with pretty much all of the providers, with most of the platforms, you can have a snapshot as of the last business day of what the exact holdings are, as well as what the weights are versus like a mutual fund. You don't always have this transparency. So I think especially in volatile markets, tough markets like this, that kind of element of the ETF is probably more powerful now than it was in safer markets a couple of years back.
What do you think about this market? Last year when I started anchoring the ETF IQ show, every week we had new launches, or we were talking about mutual fund conversions. Like it was on in ETFs. And this year, that's just died out completely.
Yeah.
Not completely.
Still a lot of new launches, definitely. I think that what's interesting, though, is that because there's been a sell-off for the last pretty much 9 months or so, especially in a lot of the thematics, actually, I think that there's room then for new competitors to come in, because typically speaking, on the ETF side, it's very hard for providers to engage with like switch activity, because a lot of the holdings historically have been pregnant in capital gains. Now that we don't have that situation, that a lot of assets are in cash at the moment, there is much more scope for like more price disruptive products to come to market, more innovative exposures to retail consumer or something like that. So I think there's still a lot of opportunity for some of these new funds to actually get into the billions, several billions of AUM quite quickly.
For those who watch Bloomberg Surveillance, you'll know that Tom Keene is triple leverage cash. But
I get worried about some of the new ones that launch, because I receive a lot of invitations to learn about new ones, and some of them I'm like, I just don't know, even with all the transparency that has increased over time that you just shared, can someone really understand the asset class that they're investing in? Like CLOs, for example. Like I worry, like it's a unique asset class.
Do you worry about leveraged ETFs, because they're uniquely used by retail? Like almost all of the ownership of leveraged ETFs is retail.
Yeah, of course. I mean, long-term holding of that can not be the right decision. So yes, I do worry about the usage of it, but I also, same thing with inverse ETFs. But I understand the reason for it. When I look at our customer base and I also see the stocks that they own, they're heavily tech-oriented, right? And so I could see why someone might want to occasionally, instead of selling their stocks that they have gains in, buy a short, some sort of inverse ETF that hedges what their exposures are. But yes, I do worry that they don't quite fully understand how it's supposed to.
And so how do you, on your platform, deal with that? JJ was talking about educating their retail base, and I think Thinkorswim is famous for having done that as well. Is Robinhood also? Yeah,
we have a whole Learn platform that we try to offer. I mean, you could literally probably almost Google our Learn platform and find anything in terms of a topic. I also have a weekly post that goes out and tries to educate on what's going on in the market or what's happening in particular areas like options or ETFs. So yes, we're always trying to help our customer understand what they could own.
Amanda, what do you have to do about that in terms of registered investment advisors? Do you walk them through, right, especially new products?
Yeah, absolutely. So we're roadshowing quite a lot kind of throughout the year. We just came back from a China roadshow, for example, that was cross-country with RIAs, with independent broker-dealer advisors and also wirehouse advisors. And it's funny because China A-shares ETFs, for example, have been in the market for over a decade now. We just celebrated that anniversary. And still we need to talk about the nuances of China equities, for example, why an A share, why not an H share, why not an ADR, things like that. I think that can be extrapolated to so many other themes as well. So we don't offer leveraged and inverse, but we know a lot of investors, even from that FINRA registered perspective, are still very hungry for that kind of content or that kind of information. I think as well it's about the fact that 60-40 kind of hasn't been working in the current environment. So also a lot of the education we're providing is also about just broader portfolio construction as well. And we're finding that's actually the more useful information at the moment than like the implementation piece right now, because clients want to be lined up from that perspective first, and then when they're ready to dip their toes back into markets, that then they can consider the implementation tools then.
What do you offer?
Education?
No. I was thinking about like model portfolios or ways for investors at Tasty Trade who don't necessarily want to learn to get down deep into the weeds, but still to put together,
we offer, we do every day we do 9 hours of live streaming content, except when Matt's on the air across it says, we're taking a break right now, be back when Matt's done over Bloomberg. So with that, we offer a lot of things. As far as model portfolios, we really don't necessarily do that. We cater to a more active trader base. And so, our clients aren't necessarily, I will say this, we're not trying to compete with the Fidelities of the world where people have their long-term money. That's not our game. We're dealing with people who, as I say, are a bit more active traders. That other part of their portfolio, a lot of our clients, most of our clients will trade a derivative product, whether it be a covered call up to futures. So it's interesting when you ask about triple leveraged a moment ago, because what we often see on the triple leverage is it's a stepping stone. And what I mean by that is people come in with equities, then many will go to options, then many will go to a triple leveraged ETF before they go to futures. They don't necessarily want to get futures permissioning. They want to use some of the leverage that they can. They're trying to learn about the markets, et cetera. So it's really interesting how many people use that. And again, I don't think that that's necessarily understood by a lot of the people who look into the market, that people who have knowledge of other things are trying to use that in a different way. There are always going to be people who use products that shouldn't. I mean, if everybody had discipline, I could walk past the Oreo cookies and not have a problem. But all that said, I really think that that's an underrated element of this.
I totally get that, wanting to use that before futures.
Mm-hmm.
You wouldn't mind, Steph, though, competing with the Fidelities of the world, right? I mean,
no, not at all.
And you do have model
That's
portfolios.
the big dream.
Yeah.
We do, from a kind of recommendation perspective, we don't manage ongoing portfolios, but we recently launched retirement accounts, and we knew that was a place that our customers would want kind of diversified long-term exposure, and so we do ask them a set of questions and then provide a portfolio for them that they could invest in and add to over time. And it's been popular amongst our client base.
Have you thought about direct indexing, or what do you think about that?
We have, and we do have fractional shares, so it makes it easy to do from a low minimum perspective, but it hasn't been the right time yet to kind of provide, like, we figure customers can build it themselves, but we're always looking at tools.
Well, it's brand new, right? But it's just, I think, such a fascinating product. And it's also like the shiny new thing this year in ETFs, but maybe it's too early for retail investors to be to
Yeah, I mean, I'm sorry, we're talking to...
No, I was talking to you, but Amanda, do you...
Are you talking to me?
So it's just something that we talk about on the show a lot, right? And the idea of building your own index, especially in an age where ESG, there's a backlash, but you can create your own.
You can choose what your mission is.
Yeah,
exactly.
thematic, same thing. Right. Yeah, I think personally, I'm all for giving investors choice. But I think that sometimes when you give them too much choice, they're like a rabbit in headlights, Yes. And I think a little bit like that with direct indexing, if I'm really honest. I think maybe for some more kind of high net worth, more sophisticated investors, perhaps it makes sense. But let's be honest, there are thousands of ETFs in the market. They already have a lot of choice.
Very inexpensive.
Very inexpensive, and also with tax efficiencies inside the wrapper. Yeah. So we did read some research recently that in reality, the direct indexing, it's often proposed as like a tax minimization tool. Yeah. In reality, very little tax loss harvesting actually took place in those mandates. So just want to put that out there.
Well, I mentioned ESG. I was talking about you, and it said you can ask Amanda about ESG.
Yeah, exactly.
What do you think about this? Because it was so huge, and it also makes sense, but it's just so hard. It's different for everybody, right? What ESG means. So how do you sell a product to everyone when each person feels differently about what it should be?
And I think probably all of us in this room are maybe looking towards the regulators to try and provide a little bit more clarity in terms of, from a US perspective, what does ESG mean? Obviously, we know all of the different opinions from a state level perspective, but also from an individual perspective. In Europe, there was the benefit that the European regulator basically defined kind of a spectrum of ESG. So that's made things a little bit easier, and that's also made the utilization and penetration of ESG much easier as well. So that exercise is pretty much done in Europe. A lot of assets have converted to an ESG stance, be it light green or dark green. Here in the US, I think we have some different concerns. So we hear a lot more about the S pillar and like interest in this perspective from our institutional investors in particular. And also for some of those too, they've made very strong statements about
meaning
helping.
the S meaning like
the S pillar,
they want to
social
own businesses that have a certain number of women on the board, for example.
Yeah, or even things like, what's the CSR policy of the companies that we're investing in? Is it constructive towards US society? So we're really lucky that a number of the data providers now have enough data points on even that sort of stuff. And so we're doing a lot of customization on that side. It's not ready yet in an ETF format, but we're able to do institutional customized mandates that way for pension funds, insurance companies, and so forth. The other angle I would say is that the climate piece within the E pillar, the environmental pillar, is really standing out at the moment. So I think also linked
especially here.
yeah.
You know?
Well, I think this is it. Like, I think they're still ascertaining if these specific ones were created by humans or if it was natural.
It was the Canadians.
They're all in the forms of hockey sticks.
But either way, I think this is the kind of thing that can be happening. So we all know that we need to reduce the temperature of the Earth, and some investors have enough money that they can make an impact with their equity and fixed income investments.
Does retail not care?
No.
Or
our client base cares. It may be based on my previous role, I would say it was a generational thing a little bit more, in that the younger cared more about it.
What was your previous role?
I was at JP Morgan, and I served ultra high net worth and high net worth clients, investing for them. So I felt the older generation would sort of say, yes, I care about that, but I don't care about it for my money. And I feel as though the younger generation cares about it for their money. And we see it in some of the research we do as well.
But I think people still vote with their dollars.
Broad generalization.
I don't disagree with you that I do think it's more, I will say younger you are, probably the less likely you are to buy ExxonMobil. But if ExxonMobil is rallying, across all ages, they'll buy it. Mm-hmm. And so I think people still vote kind of with their dollars when they, it's the market, they want to make money and they see an opportunity to do so, people still will.
All right. Very cool. All right, I have to get down to the live television studio. But it's been great talking to you guys, so thank you very much for joining us.
Thank you.
And hope you enjoyed the panel. So Stephanie, Amanda, JJ, let's go. Thank you.
All right.
Thank you.
Thank you to our ETF panelists. I'm now pleased to continue things with my discussion on the evolution of options trading. Please welcome Joe Mazzola, Director of Trading and Education for Charles Schwab, and Brian Donlin, Head of Options and Equity Derivative Strategy for Stifel. Joe, Brian, we have to talk about how, investors went into this year positioned for one scenario and got something totally different. The labor market continues to breeze through all the rate hikes that we've gotten. The recession forecasts are being pushed out again. We've just had 2 consecutive quarters of positive returns on the S&P 500. We're at this halfway point, and investors are still very uncertain about what the rest of the year will look like. So, what is the options market telling you about sentiment? And are you seeing a difference between retail investors and institutional investors in terms of the types of contracts that they're executing? Let's start with you, Joe.
Sure. So I think, even heading into the last couple of weeks with the debt default, you saw a lot of protective hedges in place. We saw in the S&P 500, we saw a lot of put buying, so a lot of skew that really was kind of multi-year highs. So a lot of the protection was already in place. A lot of that kind of pulled back after the debt deal announcement. And you're seeing a lot of positioning on the retail side. It's not, I wouldn't say it's anything to a level where it is outrageous, but you are starting to see a little bit more of kind of some call upside buying. Especially if you look at some of the tech names, and I think that's important. When we're starting to look at some of the names that have really outperformed, we're starting to see some signs of chasing a little bit. I wouldn't, like I said, it's not something that I would point out as a turning signal, but it is something to kind of keep an eye on. So that is one of the things I've been looking at is what is kind of the volatility looking like in some of those upside calls, just because right now in some of those tech names you do start to see a little bit of that.
Brian, what are you seeing?
Yeah, so I speak to a lot of investors who are very frustrated. Especially long short hedge funds, gals that are trying to pick stocks. It's really tough right now because you can have a company put up a good print and then you have sort of a macro move and you don't get the reaction you thought, and then 5 days later you do get the move. And so what I see is more people than ever that haven't traditionally used options, both on the retail side and the institutional side, using them to get into areas that they normally wouldn't. A long short tech PM isn't trying to forecast interest rate policy, but he's forced to kind of have a macro view from a risk perspective, and using options is a really good way to kind of be there without having to be overexposed and getting involved too deeply in areas that just aren't your core expertise, but now you're forced to be part of your mosaic, your investment thesis.
Makes sense.
I want you to elaborate on that a bit, because the S&P 500 is hovering near bull market territory but still struggling to break out of that. How do traders incorporate options to trade in these range-bound markets? What kind of tools can they use in order to get a little bit of upside when there's so little conviction in the market?
Yeah, so I think it depends on what vehicles you're in. So if you're in ETFs, I think to Joe's point, you're going to start to see some with SPY options, kind of where they are. Calls are really cheap, and they're a great way to kind of be there. Well, I like to say without being there. I think for the single names, it's a bit more mixed. I've seen some stock replacement, and that takes various forms. Some of it can be just actually selling stock, replacing with calls, doing risk reversal, selling a put, buying a call. Everybody's trying to do the same thing, kind of be there, but until the interest rate curve really kind of normalizes, and that brings like a much better level of stability, and you see kind of the VIX curve flatten, I think people are going to keep trying to find these different ways to not miss out on performance. But nobody wants to get caught in the next 5 to 10% kind of downdraft is the predominant theme that I see taking place.
Yeah, we teach a lot of spreads, and so we provide a lot of education for our clients. We have courses that they can take, online courses, webcasts, videos, everything that we do, articles along the way. And we talk about spreading strategies a lot, especially in this environment. On the single stock side, especially on the tech names, you could take advantage of like an in-the-money call spread by buying a strike or two in the money, selling something a little bit out of the money, replacing that, as you mentioned, taking some of that stock risk off the table. The one thing you need to be mindful of is if there's some capital gains associated with that. But if you're like in an IRA account, you can have a spread strategy in that account. You can sell maybe some of that upside, sell some of those shares, replace those with the debit spread. And if the stock continues to go, what have you done? You're optimizing that capital a little bit better.
So we have the Fed meeting next week, and we're likely to get a pause or what they call a skip. And everyone's kind of been waiting for this moment. One of my brilliant colleagues, Elena, was looking at data in the terminal and saw that investors are actually using options to hedge for, a potential rally when the Fed does pause. What kind of activity are you seeing leading up to the Fed's next meeting?
Well, like I said, in the last, with the debt ceiling, what we saw a lot of was that put skew, the buying in there. We're still seeing that a little bit, but that's more on the index and ETF side. As you mentioned, the ETF calls are cheap, right? It's really looking on single stocks relative to the ETFs and the indexes. You're really starting to see that spread. There's a divergence between kind of the single stock skew and then what you're seeing on the ETFs and the index side. A lot more hedging with the ETFs and indexes, a lot more speculation on the calls.
Yeah, and I think it's a good point, and Joe and I were talking about this before. There's not a one-size-fits-all, I think, when you talk about volatility and when you talk about options in general. It's, when you're looking at index options, equity, and let's just talk about equities, not any other asset class. But if you're just looking at index options, it's going to be very different than ETF. And then when you get down into single names, it's going to be totally different. And I think even within a single name, depending on how long you've had the position, what your time horizon is for that position. In one name, we could be talking to one client and we're advising, just sell some calls. And to another client, who's never going to sell the stock, we're saying, all right, we'll do this, put spread. This is protective. You can roll this once a quarter. So I think, the beauty of this environment, and as education around options continues to grow, is there's not a one-size-fits-all strategy, and in one name, you can have a different approach for 4 or 5 different clients. And I think people are becoming more aware of that, both on the institutional side and the retail side. And I think we've seen more, and I think that's why you continue to see the option volume continue to grow.
And it goes to the flexibility of options. I mean, that's the bottom line. And you're spot on with that. I used to be on that side as well too, working with RIAs and in client portfolios. And you don't sell one strategy, right? There's no one size fits all. But the beauty of options is that flexibility, where you can look at a client, look at their portfolio, how that asset works with the rest of the assets in the portfolio. Or, for some clients that might have literally a nickel or dime cost basis on a $50 stock, where they say, no way can I sell the stock. What strategy do you build around that? And that, like I said, that goes to the flexibility of what we do.
I would be remiss if I didn't ask you about something that's been a bit of a hot topic, which is the boom in zero-day options. Bank of America had a note where they estimated that zero-day options comprise about 45% of total S&P 500 options volume, compared to just 5% 10 years ago. What's driving this boom, and how is it impacting the equity market?
Well, I mean, look, every option is a zero-day option at some point, right? I mean, and I think that's it's led to an increase in volume. I think that there needs to be more education around that from my perspective. I don't think that enough clients understand kind of what gamma risk is, and the pin risk, and what can happen if you literally settle right at that strike price. So from my perspective, yes, it's been great to see additional volume, and it's been great to see additional players within that space. But I also believe that education needs to go along with that.
Yeah, I think it's kind of interesting, because I always get the question, are zero-day options exacerbating volatility? Are they depressing volatility? And I actually think it's a little bit of both, because for every buyer, there's a seller. And I think, like any other asset or any other good, when you increase the supply, you increase the availability. You're going to dampen prices, and I think that's what's happening in really the short-dated, the zero-day type of options. I do think it is depressing volatility, because even if you're on the other side of that as a bank, a JP Morgan, a Morgan Stanley, there's still weekly, right? So it's not that there's just zero-day and monthly. There's weekly, there's next week, the week after. So there's lots of ways for dealers to kind of spread these off that wouldn't create the normal volatility you might see by thinking somebody's caught short. So I do think on one level they do depress volatility, but they also came after you already had so many other time intervals. So I think it's a natural extension of what we already had. And coming back to what I said earlier, I think they give a lot more people the ability to hedge this event risk in this macro-driven tape. So I think it's kind of worked out for everybody. But I think, to Joe's point, it is really important to understand, some of the parameters around these, so because you don't get caught. It's not always that simple, because they can pin. They may not perform exactly as you think, depending on when you buy them, the time of day. There's a lot of nuances to it. Yeah.
I think where the benefit is, he's talking about kind of that binary event-driven risk. In the past, what would happen? You'd have to buy a 30-day option to hedge a 2-day event, right? That doesn't make a lot of sense. People don't want to pay that time premium for that 2-day risk. So it's provided a lot of flexibility, and I think that's great. just want to make sure that people kind of understand the risks that are involved if we're not closing those out prior to expiration.
What is going on with the VIX? I think that's a question that has been on everyone's mind. JP Morgan said that it was the push-pull between short-dated options and longer-dated options that were causing some of the stagnation. What are you guys seeing there?
So I think people always focus on spot VIX. Mm-hmm. I really focus on the curve. Mm-hmm. And simplistically, like what's the spread between the first month and the second month and the third and the fourth, and I think that's generally the most telling of kind of where sentiment is right now. And when you look at the VIX curve, it's very steep, and so I think when it first goes into that position, I think it's definitely a bit of a risk on type of mentality. But I think the longer it sits there, I tend to think of it more as a sign of complacency, and everybody's kind of waiting for that next shoe to drop, right? And so they're able to use these 0-day options, mm-hmm. and so they don't have to move the portfolio too much. Once again, I think it simply boils down to kind of where interest rates are going to shake out, and everybody's waiting for the next recessionary shoe signal to drop. And so I think you can't get too hung up on looking at just where the VIX is today. It's really looking at the curve that gives you a better assessment. And right now, I think everybody's time frame, even our equity strategist at Stifel, he's like, I can't think a year out. He's like, I'm forecasting 3 months and in. And I think that's really what the VIX curve and where spot VIX is relative to the back months is telling us.
And just look at performance of buying protection over the last 90 days, right? You're losing money, and even in 22, when the markets pulled back, volatility came in as well too. So just buying hedges against long equity positions didn't work because it was a slow grind down, right? There wasn't that one big day move. It just kind of matriculated over time. And then the last 90 days, realized vol versus implied vol once again is negative. So or positive, I guess. So what that tells you is that if you're paying up, you're not being rewarded for those hedges, and so you need to be a little bit more short term. You need to think a little bit, instead of hedging an event that's occurring 3 months in the future, you tighten that horizon so you don't have to pay as much time to get.
Brian, you mentioned that everyone is waiting for the next recessionary shoe to drop. If that doesn't happen, if instead we see more positive catalysts and we do see a breakout, how does that change the picture?
I think it depends on the data that gets you there, because you've got such a bifurcation now between kind of where the service economy is, where the manufacturing economy is. And I think it's going to take a while for kind of who's right to be settled, and it's going to be more of a grind, and I don't think you're going to get, this snap back in interest rates. I don't think the Fed's plan is to take them back to zero. So I still think the market is kind of digesting, not just are we going to go into a recession or not. I think everybody realizes growth is slowing, but how low are rates actually going to go this time? And then what is really the long-run trajectory of nominal GDP going to be and real GDP going to be? And I like I said, once again, when I come back to looking at the VIX curve, I think everybody's still kind of guessing.
I mean, I think it's possible to say that the 40-year bull market in bonds, might be coming to an end. I mean, I think it's very possible. And, kind of what does that mean to the curve, and what does that mean for assets going forward? In my opinion, a lot of that cheap money that has been around for the last 15 years, that's supported a lot of the companies that, I don't know if you want to call them zombie companies, whatever you want to call them, where they were able to kind of roll forward interest rates and basically get that free flow of money. That's changing. It's a changing dynamic, and could it have repercussions in the future? Absolutely. I think you'll see a lot of consolidations within industries, and that's going to kind of change the dynamics of the market as a whole. Why is it not happening right now? I think that's anybody's guess. Trying to figure out when that happens. But as long as we can continue to push out this narrative that, well, the recession is going to start here, well, no, it's going to start here, well, no, it's going to start here, I think the market's just trying to digest all that. That's a lot to kind of take in. And, from an options perspective, they're trying to price implied volatility around that, and that's becoming more and more difficult.
Joe, I know investor education is a huge part of your job.
Absolutely.
Let's say you have a retail investor who has never incorporated options into their strategy. What is the first thing that you tell them about how they can go about doing this?
Yeah, I mean, we always kind of start off with risk-defined strategies, right? I mean, that's rule number 1, 2, and 3 from the retail perspective is let's look at a risk-defined type strategy. A lot of times it's the first trade might be a covered call, right? That might be the first one. We say, okay, do you own 100 shares of a stock? Is this something that you're willing to, to have called away if it's at a higher price, you want to generate income? But a lot of our focus recently has kind of really been on spreads, whether that's credit spreads or debit spreads, just because we like the idea that it's defined risk. Now, it's defined, within a certain range, right? If the stock settles in between those strikes, that can cause some additional risk. So we spend a lot of time on education. We have webcasts, like I said, we have videos, we have coursework that supports all that.
Brian?
Yeah, I mean, I think I would echo a lot of what Joe said. I think for us, it really comes down to, taking a step back. Okay, you want to use options, but let's think about that within the context of your investment statement, right? And working with the advisor and the client to get a more holistic picture of, what their goals are. Because there's tax implications, as Joe talked about, and, there's risk around, can a stock be called away? Can a stock not be called away? Capital gains, if somebody got another vehicle that they're using for tax loss harvesting that could be used to offset, short-term gains in the option. So, I think you just can't use them as a standalone. You've got to use them within the context of not just the portfolio, but with all the assets that the client has, and think about tax strategy and things like that. So that's a lot of what we do. I think from a strategy standpoint, once you have that, the strategy kind of presents itself. Like you kind of know what to do. It's really making sure it fits in with the context of the investment goals. That's really the hardest part in the beginning, and probably the most important part.
And that's such a critical point that Brian brought up. Is people look at options and they think of them as a trading product. You should look at them in terms of an investment product within the entire portfolio. I mean, to me, that's the difference, and I think that's the evolution of options, and that's where it needs to continue to grow to.
Thank you so much, Joe and Brian, and thank you to all of our fantastic panelists and guests here today. If you guys have any questions for these guys, you can probably catch them downstairs during the networking sessions. Thank you so much, and of course, Bloomberg Invest will continue downstairs at 1:15 with Mark Patrikoff and professional golfer Michelle Wee West. Thank you for being here. Thank you so much. Such a pleasure. Thank you both.